Friends, now we will start our session with the second speaker, CA Dolphy D'Souza. The introduction is already in the hands of the delegates. He is the Chartered Accountant, Cost Accountant, Company Secretary from our institute and Management Accountant from the London Institute. And he is a senior partner and member from firm of E&Y Global and heads the Assurance Technical Department, which also includes IFRS and Ind AS. He has authored many famous books and we all are reading these books and learning more and more. So please welcome CA Dolphy D'Souza from Mumbai.
Good afternoon, all of you. You have done a good thing by investing your time and coming to this session. Now I demand your attention so that I can give you the best return of your time. The standard that I am going to give you essentially is the new revenue recognition standard. Now what I would like to do is to have this session become a very interactive session. So please ask me questions. I think there are mics around here. If you do not ask me questions, I will ask you questions so that you can keep me awake, I can keep you awake. And if you find somebody sleeping next to you, you ask your question a little loudly so that he can be kept awake as well. So let's make this session interactive. I think there are 2 hours that we are going to invest in understanding this standard. It's a standard that, excuse me, can you take the photograph later? It's a standard that is substantially different from what we are used to under AS 9, and therefore we need to go through this standard step by step, understand each and every step. Otherwise, fundamentally revenue recognition is so critical. The biggest frauds happen on revenue recognition, right? So in our memories, the couple of frauds that we have seen in the past have been related to revenue recognition. So it's very important to understand this standard and how this standard is being implemented. As I said, it is substantially different from what we are used to in AS 9. So I really demand your attention so that we can have the best return for your time. So the way we are going to do is, we're going to look at overview and scope of the standard. What is the contract, the various performance obligations in the contract, the transaction price, the allocation of the transaction price, and recognizing revenue on the performance obligation. So all this will sound to you gobbledygook to start with, but as we go with very simple examples, the standard and the application of the standard will become easier. So I really command your attention. Otherwise, if you miss on the earlier steps, you will, the later steps will not make any sense to you. By the way, I would like to pronounce Ind AS as Ind AS. When I was watching CNBC, I saw Menka calling Ind AS as Ind AS. So I had to call her up and say, please show some respect. Don't call it Ind AS, call it Ind AS. So I think now she has changed and calls it Ind AS. So essentially, to start off with the revenue recognition standard, under US GAAP, you had plethora of standards. The same principle being applied differently to different industries, and too much of detailing on the revenue recognition standard, causing several inconsistencies in the way the revenue recognition standards were applied in US GAAP. In contrast, under IFRS, IS 18, there was very little on many aspects of revenue recognition, whether it is with respect to variable consideration, whether it's with respect to multiple element contracts. So there was very little in IFRS on many of the complexities that we face today on revenue recognition. So the ISP and the FASB board got together and said, look, let's have a very comprehensive standard that will deal with these issues thoroughly. Now when they issued, and finally they issued a standard, they realized that there were far many implementation issues coming out of the standard. Consequently, FASB delayed the application of the standard to 2018. Even ISB has delayed the application of the standard to 2018. Because there is a transition resource group that is looking at many of the interpretation, implementation issues at this point in time. So they did not want to implement the standard immediately unless some of these issues got resolved. Unfortunately, the position that we have taken in India is that we are not going to apply IS 18. We are going to apply IFRS 15 straight away. So India would be the only country probably in the world that applies IFRS 15 right at the inception. So it's not the dog that is going to wag the tail, it's the tail that is going to wag the dog. So what we do in India now is going to be very critical as far as the world is concerned, because we are going to take certain interpretative positions and which the world will be closely watching. So I'm very careful when I'm looking at a IFRS or an Ind AS conversion of a multinational company which has a subsidiary in India. I take precaution to say that, look, are we taking the right interpretation? Because otherwise what will happen is going to cause embarrassment at a later date when the global parent company takes a different view on the same fact pattern. So the implementation of IFRS 15 or Ind AS 115 for us is very critical. The fundamental change in the revenue recognition standard is changing from transfer of risk and rewards to transfer of control in the goods and services. Again, this will sound very gobbledygook to you, but as we go with those various examples, it will be clear to you what is the fundamental difference between what we are doing in AS 9 and what we are supposed to be doing under Ind AS 115. The first thing that you have to do is to say, this standard applies to what? Because if you apply Ind AS 115 to some other transaction, it's going to cause confusion. So the scope of the standard is very important. What does this standard apply to? So the standard applies to contracts with customers with respect to revenue recognition. It applies to, can we sort this out because it's flipping back and forth. I think maybe we'll continue for about half an hour and then maybe after lunch we can. So it essentially applies to contract with customers, sale of non-financial assets. So for example, if you have sold your fixed assets, how do you recognize income on that? That is also dealt with by the standard. What the standard does not deal with is leasing contracts, contracts on financial instruments, contracts with respect to certain non-monetary exchanges and certain put options on sale and repurchase agreement. Again, we will discuss all these things as we go through these presentation. It's a 106 slide presentation, so there will be numerous examples. Now, to give you a simple example, what is it that so certain non-monetary exchanges are not covered in the revenue recognition standard? So what are we talking about? So for example, let's say if I sell milk to a customer and the customer sells milk to me in some other state or in some other region, this is non-monetary exchange which does not have substance, and therefore I should not be recognizing revenue and neither should the other person be recognizing revenue. So those also would be scoped out. The model essentially, the core principle in the model is recognize revenue to depict the transfer of promised goods or services to customer in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. And there are 5 key steps to how you're going to recognize revenue. Very simple steps, but as you start detailing those steps, it gets very, very complicated. It's in the nature of these things because the world has got so complicated. And what are those 5 steps? And we will be dealing with each of we'll have multiple slides on each of these steps. What are those 5 steps? The first step is identify the contract with the customer. The second step is identify the performance obligations in the contract. So you have a contract with customer, but you are not just selling him one good or one service, you are selling him multiple goods and services. So you have multiple obligations. So if you are selling software to a customer, you are also providing maintenance services, telephone support, update services, and so on and so forth. So there are multiple obligations. And it happens through many contracts, and sometimes it may not even be apparent. So for example, if you go to a builder and buy a property, the builder says, next time you buy from me another property, I will give you a discount of 3 lakhs or 4 lakhs for a repetitive purchase. Now this is another performance obligation. So it's just not the performance obligation of having sold the property to you, but another performance obligation which is of providing you an option to buy another property at a price that is cheaper than what it would be offered to another customer. So identify the performance obligations in the contract, determine the transaction price. What is the total transaction price in the contract? So there is a contract, there are many performance obligations. what is the total transaction price in that contract, and you allocate that transaction price to the various performance obligations, and then say what are the transaction price for each of these performance obligations, and then you recognize revenue as you fulfill and satisfy and do your job or completely satisfy each of those performance obligations. So as you satisfy those performance obligations, you recognize the revenue that was allocated to the performance obligation. So this is the principle, this is the theory, this is the concept. Now we will deal with multiple practical issues in applying this, these steps. In its construct, it looks very simple, but in its detailing, you will get to a number of things such as a variable consideration and financing component and so on and so forth. And by the way, to get your attention, I will be asking you questions so that we make these sessions interactive, or hopefully you would be asking me questions. What was the first step? The first step was to identify the contract. Now, what is a customer contract? A contract exists if collection of consideration is probable. A contract exists if right to goods or services and payment terms can be identified. A contract exists if it is approved and the parties are committed to their obligations. A contract exists if it has commercial substance. Now, each of these four criterion are important for a contract to exist. Importantly, I think the most important thing is that a contract has to be enforceable. It could be an oral contract, it could be a written contract, but it has to be an enforceable contract, because if it is not an enforceable contract, then it is not a contract which is within the scope of this standard. And what is an enforceable contract? So a contract that can be cancelled by either of the parties without paying any penalty is not really a contract that will be within the scope of this standard. So important to understand that the contract has to be enforceable, which means it has to be real, it has to have substance, and it should not be cancelable by either of the parties based on their whims and fancies and without having to pay any penalty. Now let me ask you a question here, and then let us pause here for a while. So let's say I enter into a contract with a customer. I'm going to sell you 100 units at 100 rupees, and immediately I also enter into another contract which says I will sell you 100 units, but I will sell you at 90 rupees. So there are two contracts that are entered into simultaneously, 100 units at 100 rupees, the other 100 units at 90 rupees. And you supply the first 100 units. What is the rate that you will apply to recognize revenue in this new scheme of things? Do we have the mics that they can? I hope the mics are. No, there is no exchange. The goods will be transferred. So there is a contract to sell 100 units at 100 rupees. Immediately there is another contract with the same customer to sell 100 units but at 90 rupees. And the third day I am selling 100 units, and maybe a year later I am selling 100 units. So when I am selling the first 100 units, what is the rate I will apply? So you will apply 100. Anybody else? Any good ideas? You will average out, right? Right, so I think you will average out. So you will, the first 100 unit that you will sell, you will not recognize at 100, you will recognize at 95, because you will average out, because the substance is you have agreed to sell 200 units at 95 each. So therefore, वो इन्वॉइस तो छोड़ो उसको, वो तो टैक्स में चल जाएगा आपका, लेकिन जो अकाउंटिंग है इंड AS 115 में वो 95 पे होगा. दैट इज द रिक्वायरमेंट ऑफ द स्टैंडर्ड. फॉर सेल्स टैक्स पर्पसेस एंड इनडायरेक्ट टैक्सेस यू विल डू इट एट 100 पे. Sorry?
So how can we do different raise invoice at 100 and in the accounts we account it at 95 rupees?
So your invoice may be at 100 rupees, but what you will do is you will create, for accounting purposes, you will create a deferred revenue of that 5 rupees difference.
Okay, so we will get deferred.
So because you will get cash of, let's say, 100 rupees,
yes,
right? But for accounting purposes, you will create a deferred revenue of 5 rupees, which you will recognize subsequently.
Yes,
so what happens in substance is, the first lot gets recognized at 95 and the second lot also gets recognized at
Thank you, sir.
95.
So,
No performance obligation attached. Then why you are averaging out these two?
Yeah, that is because of this theory. Now I'll explain this theory. Contracts entered into at or near the same time with the same customer must be combined. Yeah, this is must be combined if one or more of the following conditions are met. They were negotiated as a package with a single commercial objective. Consideration to be paid in one contract depends on the price or performance of the other contract. Some or all of the goods and services promised in the contracts are a single performance obligation. So these criterion are met, and therefore you will have to combine these two contracts for accounting purposes. For your sales tax and other things, it will go with the invoices and the agreement. But for accounting purposes, this is the effect.
so what happens to the customer loyalty programs or the gift voucher which we issue at the time of purchase? That next time when you come, I will give you 500 rupees discount.
Gift vouchers will come to later. So you are now on slide 60. So and I am on slide 9.
Receivable. This deferred revenue of 5 rupees will it not impact the trade receivable because there it will book it for 100 rupees only.
So you have let's say you have sold 100. You have got cash of 100. 95 is your revenue. 5 is your deferred revenue. Now let's say if you have not received cash 100, you will show receivable of 100. 5 will be deferred revenue. Okay. So I think the first. No. When you enter into a contract at the same time with an objective of actually.
Look at it. Because every day if I have to make 190, then every day I have to make the provision. That is not going to happen. Only at the end of the year I should see what is going to be my liability.
Yeah, so but you are also preparing quarterly accounts. So
Yes, quarterly is, but at the financial accounts, normally at the end of the year, only the closing entries, at that time we should consider. Otherwise, if I do everything, the invoice and everything, then what will happen with the accounts? Throughout the day we will be busy with that. Only our ultimate aim is true and fair at the end of the year. So at the closing only we should find out what are the entries that is going to affect, and only at the close only we should consider this.
Yeah, what you are saying is a very simple thing. So in a quarter you are saying I have sold 100 units and I have sold the other 100 units. So then it gets automatically accounted at 190 and an average 95. So you don't have to worry about it. But there are two ways of doing it. The more sophisticated companies will do it for every transaction because it's all system driven. The more smaller companies that use Tally and other things, they will do it at the end of a reporting period. So that is in the detailing how you want to do it. But this is the application of the standard.
So one small question, will this also apply if the price is related to either indexed to some alternate price like say a commodity price, or will this treatment be same or?
No, that is another performance obligation, or that's more of a variable consideration. So we will come to that. So this is just a very simple example of how you combine the contracts.
Sir, I would like to interfere. It may so happen that the price of my products keep on changing. It cannot be static throughout the period. It may be changing every day or on a monthly basis or a fortnightly basis depending on the management's decision when to revise the prices. And the understanding with the customer is also that the price prevailing on that date will be charged. So how do we take care of this? And
So
every transaction is a separate transaction in itself. It cannot be said to be a composite thing, a portfolio contract which the company has entered.
Right. Your observation is very astute. I think it's a very astute observation. So you are saying that the price today is 100 rupees, the price after 15 days is 90 rupees, in which case you should not combine the contract. So you saw the requirements of combining the contract. When you are actually with an intention to deceive or with an intention to create certain accounting effects, that's where you combine the contracts. But when you have sold 100 at 100, when the price was 100, and subsequently many days later you sold 100 units at 90 when the price was 90, then there is no question of combining the contract because you have not really negotiated those contracts as a package. What we are talking about is combining contracts when those are negotiated as a package with a motive of creating certain accounting effects. Okay, so now we move on to the next step, identify performance obligations. I think when do we want to take this? Is just flipping in and out. Because this is creating some problems. So I think each level. Okay, so I think as far as you are fine with it, we can go ahead. But so the second step is identify performance obligations. Now this is a very important step. What is a performance obligation? You have a contract. You have multiple performance obligation. What is a performance obligation? A performance obligation is a promise, explicit or implicit, to transfer a distinct good or service to a customer. So the good or service has to be very distinct. Now we will come to what is a distinct good or service. Performance obligations are identified at contract inception. Performance obligations are identified at contract inception and determined based on contractual terms and customary business practices. Incidental obligations or marketing incentives may be performance obligations, such as free maintenance provided by automotive manufacturers or loyalty points provided by an airline or a hotel company. Those were obligations in a contract. So when I am taking a flight from Bombay to Kolkata, I'm not only it's not only paying the airline for that flight, but also paying the airline for the loyalty point that the airline is going to give me. So the airline has two performance obligations. One is the main travel itself, and then the second performance obligation of having to fulfill and satisfy its obligation on the loyalty points. Obligation does not include activities to satisfy an obligation unless a good or service is transferred, such as a setup activity. Now this is important. A performance obligation does not include activities to satisfy an obligation unless a good or service is transferred, such as a setup activity. Can somebody give me an example of what this could be, that it is not a performance obligation, which is a setup activity? Can we move the mics, please? We need to move the mics. Yeah. Yeah, I think very close. But give me a very simple example of what is a setup activity, which is not a performance obligation. Because performance obligation is only when you transfer a good or service to a customer. No, warranty is a performance obligation.
Supplying accessories with the main machinery.
No, that's not us. So basically, let me give you an example. You go to a school to get admission, right? Now they are charging you an admission fee, and then they are charging you a tuition fee. Now when you are going to the school and paying admission fee, are you getting a service? You are not getting a service. You are just getting admitted to the school for the service to be rendered over the next year, which is the tuition and the books and everything else. So the setup activity, which is the admitting a student, is not an activity which is a performance obligation, and there should not result in a revenue recognition. So but under Indian GAAP, we do recognize revenue even for setup activities. So the way you look at performance obligation is, have I transferred some good or services to a customer? And if I have transferred a good or service to a customer, that's a performance obligation. I can recognize revenue on performance obligation. But an admission fee, admitting a student to the school, is not a performance obligation, because I'm not transferring any goods or services to that student. I'll be transferring goods and services over the next 1 year by way of tuitions and providing him the reading material and so on and so forth. So setup activity should not result in any recognition of revenue. Typically another example would be a telecom company or a cable TV company. They come and do some fixing. Now that is not really a service. What is a service to you is the moment you start getting the cable connection and the movies and the channels and so on and so forth. So any upfront work that a company does is not a performance obligation, because it does not result in a goods or a service being transferred to a customer. It is not a revenue. So it is just the cash collected from customer in advance. And how you will treat admission fee, we will come to that. We have some simple examples to help you, but essentially it's a deferred revenue or a advance collected from a customer.
Sir, in case the last example you gave regarding that telecom company which provide us these fixing all this before providing the services, all the instrument they used to provide.
Sorry, I can't get you.
I said the last example. Can you go to the last slide?
Yeah.
So the last example you given the telecom companies. So in this case, the goods are transferred to the customer. So in that case also, I mean, it won't be taken as a separate service.
No, the service is not the it's not the switch being on, but it's you are being able to make a phone call. That's the service, right? Just getting a connection is not a service to you, because the service comes later after you have got the connection.
Okay, sir, can you give me an example when the exception is given, unless goods or services transferred?
Let's say the telecom company gives you a mobile phone free, in addition to providing you with 100 minutes. Now that mobile that the telecom company gives you is a performance obligation.
Okay.
But just connecting something is not a service that you are getting. Your service is the moment you are able to speak to another person on your mobile phone.
Okay. Even if that is a transfer, but they are providing me a handset or some cords are there. So these are the transfer of good, it won't be considered as a service.
Yeah, because those are all given in connection with you being able to make a phone call or receive a phone call. So the service is your ability to make a phone call or receive a phone call or to send an SMS or receive an SMS.
Thank you, sir.
Right. I think good observations and good points. I hope we continue like this, particularly after the post-lunch session, because post-lunch session becomes difficult. Sorry? I don't think it's a standby issue, something else. We will figure that out after a few minutes. Now there are two-step model to identify which goods or services are distinct. Now this is very important slide because afterwards we will have simple examples and you have to solve the examples, because I don't know the answers, so the answers have to come from you all. So focus on this slide. A two-step model to identify which goods or services are distinct. Now why do you have to know which goods and services are distinct? Because you will allocate consideration to only distinct goods and services or distinct performance obligation, and you will recognize revenue only on distinct performance obligation, not on performance obligations that are not distinct. So very important to understand which goods or services in the contract are distinct. Step 1, focus on whether the goods or service is capable of being distinct, which is customer can benefit from the individual goods or services on its own, or customer can use goods or services with other readily available resources. Now this is very important. Customer should be able to benefit from those individual goods or services on their own, or customer can use goods or services with other readily available resources. And step 2, focus on whether the goods or service is distinct in the context of the contract. The goods or service is not integrated with, not highly dependent on, not highly interrelated with, or significantly modifies or customizes other promised goods or services in the contract. So either the goods or services, so both of these conditions have to be fulfilled in order for the goods or service to be distinct. So the goods or services, okay, so the goods or services on their own should be able to provide a benefit to the customer, and the goods or services should be not of a nature where there is a high degree of integration through those various goods and services, because if there is a high degree of integration in providing those goods and services, then those performance obligations would not be distinct. Now again, this will sound very gobbledygook, so let's focus on some of the examples to explain this slide, and we will come back to this slide from time to time. Simple example, I think I should, this is going back and forth. Can we do it after lunch, because this is going to cause, okay, fine. Because the reading the slides is very important, otherwise if it's not on the screen, it's going to be difficult. Okay, so you have to identify performance obligations, distinct performance obligations, where there are multiple performance obligations in a contract. Entity enters into a contract to manufacture and install customized equipment and provide maintenance services for a 5-year period. Installation services include the integration of multiple pieces of equipment at the customer's facility in order for the equipment to operate as a single unit. Equipment cannot operate without the installation. Entity sells the equipment and the installation services together, does not sell installation separately. Other vendors can provide the installation services. The maintenance services are sold separately. So, have you all been able to grasp this example, and what are the performance obligations in this example based on this slide that we saw earlier? So what do we have? We have the equipment, we have the installation services, and then we have the maintenance services, right? We have the equipment, we have the installation services, and we have the maintenance services. Now, having read the example, what are the distinct performance obligations in this example? Look at this slide. So let's focus on the first thing, which is the equipment. Is the equipment capable of being distinct? Customer can benefit from the individual equipment. Can the customer benefit from the individual equipment? He can benefit from the individual equipment, right? Because he can get some other party to do the installation for him. So customer can benefit from the individual equipment. Focus on whether the goods or services is distinct in the context of the contract. The goods or services is not integrated with, not highly dependent on, not highly interrelated with, or significantly modifies or customizes other promised goods or services. Is this condition fulfilled for the equipment? What does the installation service does? It's a very specific service that integrates the equipment, and therefore there is a lot of customization, and therefore there is a high degree of integration between the installation services and the equipment. And because there is a high degree of integration between the installation services and the provision of the equipment, you would treat the equipment and the installation services as a one performance obligation. And the maintenance services are independent, they are not dependent on the equipment, they do not customize the equipment, they do not change the equipment. So the maintenance is a separate performance obligation. So in this example, you would have two performance obligations. One is the equipment plus installation, and the second one is the maintenance obligation. And therefore, you have to allocate the consideration to these two performance obligations. So we will get to that in the next step.
So, but the installation services we say are independently available from other suppliers also. So, in this scenario, customer can have an agreement with supplier A for the supply of equipment, and he can appoint a consultant B for installation of this equipment.
Right. So, therefore, the first, if you look at this, the first requirement is met. What we are saying is the first requirement, but the second requirement is not met, because the installation services is very highly interrelated with the provision of the equipment. It's the two are together in a sense. So therefore the second one is not met. What we are saying is the first one. So both need to be met. Because both these conditions are not met, the equipment and the installation will be treated as one performance obligation.
It is step A1 and step 2, not step 1 or 2.
Yeah. Now let's look at another example. This is a much more simpler example. Contractor enters into a contract to design and build a house for a new home owner. Contractor is responsible for the overall management of the project and identifies various goods and services that are provided, including architectural design, site preparation, construction of the home, plumbing, electrical services, and finished carpentry. Contractor regularly sells these goods and services individually to customers. Now, what is the performance obligation? How many performance obligations are there here in this example? How many performance obligations are there?
Furnishings.
Why don't you use the mic, sir? So that
one is the construction of house. Second is making it livable by providing other services.
No, so let's say in this example, the customer is getting many services, the plumbing, the tiling, and the roofing and everything else. And he also gets ultimately the house. So what are the performance obligations here? Are there many performance obligations or there is one performance obligation? One. Because of the step 2, the services are very integrated, and therefore ultimately what the customer gets is a house where everything works perfectly. Otherwise, if they were not integrated, he would not get a house, he may get a warehouse. So therefore, because the services are so integrated and ultimately the customer has the experience of the house is one performance obligation. So in this case, as far as the supplier is concerned, how many performance obligation he has? He has one performance obligation. How he is going to recognize revenue and all of that we will come to later. This is just step 2. Step 1 was identifying the contract. Step 2 was identifying the performance obligation. We still have to go through another 3-4 steps, which is the consideration and the allocation of the consideration and the recognition of the revenue. So in this case, we have only one performance obligation. I think before we split for lunch, let's do this last slide on identifying the performance obligation. A software company enters into a contract with a customer to provide a perpetual software license, installation services, and 3 years of post-contract customer support. The installation services require the entity to configure certain aspects of the software but do not significantly modify the software. These services do not require specialized knowledge, and other sophisticated software technicians could perform similar services. The software does not require the upgrades and telephone support in order for it to remain functional. So in this case, how many performance obligations are there? No, is the installation service highly integrated with the provision of the software? No, it's a very simple installation service. It is not integrating, or it's not changing, or it's not modifying the software substantially. So the installation, the provision of the software, the provision of the installation, they all stand on their own. They are distinct in their own right. And so also is the telephonic support. So in this example, you will have 3 performance obligations, which is the software license, the installation services, and the unspecified future upgrades. Now let's take the same fact pattern and slightly change the fact pattern. Assume the same facts as the previous example. However, the installation service requires software company to substantially customize the software by adding significantly new functionality, enabling the software to function with other computer systems owned by the customer. So in this case, what would be the performance obligations? Can you move the mic, please? Is there a mic? Can you give it the mic, sir? 1 or 2? Because what we have is the software and the installation service is a one performance obligation, but the subsequent upgrades and the telephone support and all of that, that's another performance obligation. So I think we are done with 2 steps, which is identifying the contract and identifying the various performance obligations in the contract. We will keep moving ahead after lunch, and I would continue to demand your attention. As I said, post-lunch sessions are really difficult, so I would demand your attention so we get the best return for your time. In college, there was a professor, accounting professor, was a very sharp shooter. And the moment somebody used to doze, a chalk is to fall on his head or her head. And then, so we are now not even 2 down, we are only 1 down. We've identified the contract and we are still on identifying performance obligations. So the step 2 is still not complete. And so basically in step 2 what we said is 2 things need to be fulfilled in order for the performance obligation to be distinct. Whether the focus is on whether the good or service is capable of being distinct on its own, and focus on whether the goods or services is distinct in the context of the contract. So if there is a integrating service, then all of those obligations becomes one obligation. So now we move ahead. And we did all these examples to identify what is the distinct performance obligation. We are not yet done. So we still are on step 2 to identify what is the distinct performance obligation. Now we are on the topic of the customer's option to acquire additional goods and services. Does the contract grant the customer the option to acquire additional goods or services? So there is a contract with the customer to supply X units of goods or service, and there is an option to that customer to acquire additional goods and services if he purchases the first lot. So the answer is whether the option to acquire additional goods or service, is it a separate performance obligation? Now let me ask you and pose you a question here. So let's say you are my existing customer and I provide you with a 10% discount for future purchase, and there is a new customer and I am providing him 10% discount also. Are you as an existing customer having any rights or any benefit? No. So therefore that option that I give you, that if you purchase from me for your future purchases I will give you a 10% discount, is not really valuable. So therefore that is not a separate performance obligation. But if you were my existing customer and I am giving you a 10% discount, and for a new customer I am not giving that 10% discount, then that option is valuable to you and I would treat it as a separate performance obligation. So the theory is, does the option provide a material right to the customers that it would not receive without entering into the contract? If it is a material right to that customer, then that option is a separate performance obligation. If it is not a material right, then it is not a separate performance obligation. We will deal with that. So revenue is recognized when future goods and services are transferred or when the option expires. So when you are selling the goods and you are providing him with an option, the revenue on that option should be recognized when that option is exercised or when the option is lapsed. The transaction price is allocated to the performance obligation including the option based on the relative standalone selling prices. So the transaction price is allocated not only to the sale of the good or the service, but also to the additional option that the customer gets. And the estimate of the standalone selling price of the option reflects the discount a customer receives when exercising the option, adjusted for the discount a customer receives without exercising the option, and the likelihood the option will be exercised. Now this is the principle, slightly gobbledygook, but we will go with an example, and the example will help you to understand what I am trying to say. It's a very simple example. An entity enters into a contract with a customer A to sell garden supplies, and the arrangement includes a 40% discount voucher on future purchases. So the customer gets 40% discount on future purchases. Simultaneously, seasonal promotion gives all customers a 10% discount. Therefore, what is the discount, real discount that customer A is receiving? The customer A is getting 40% discount, but other customers are getting 10% discount. So what is the real discount that customer A is getting? 30%. And entity determines that there is a likelihood, 80% likelihood of redemption, and estimates that the customer will purchase on an average 50 of additional goods. So how do you value this option? So the customer is going to acquire 50 of additional goods. There is an 80% likelihood, and the discount benefit is 30%. So it's a simple formula. 50 into 30% into 80%, the value of the option is 12. So therefore, if you have sold to a customer something worth 100 rupees and you have given him this option which is worth 12 rupees, the first main goods and services will be accounted at what price? 88. But the customer has paid you 100, so what will you do with 12? You will treat it as contract liability or deferred revenue, and you will recognize that deferred revenue when the option is exercised. If the option is not exercised, it is lapsed, then also you will recognize the revenue. But this recognizing of the revenue, this true up of the estimates has to be done on a regular basis, at least at the end of each reporting period, because you estimated that 80% probability that the redemption will happen, but later on, as you come closer to the reporting period, you feel that it is not 80%, it is 70% or 60%. So you will have to true up these estimates at the end of each reporting period. Now there is also another way of doing it, which is not valuing the option but valuing the goods and services as a whole. Entity sells gym membership for 750 per year with an option to renew at a discount in 2 years, in years 2 and 3 at 600 rupees per year, right? So the first year the membership is 750 rupees, in the second year it's 600, and the third year it is 600. So this is an option that the customer gets. If you are a member at 670,
purely on estimates. What happened in Enron's case and all those things, those are past histories.
No, estimates. Enron was not about estimates. Enron was a fraud. There's no estimates. It did not happen because they could not estimate. Enron was a fraud. So let's move on to the next example.
Sir, sorry. Sir, it means that we are recognizing revenue prior to that performance bonuses. At the beginning of the year, we are doing it.
So let's say you, in your transaction price, let's say your contract value is 100,000 and you estimate variable consideration to be 30,000. Therefore, for the purposes of accounting, you should treat your transaction or a contract price as 130,000. And how you apply that, as I said, this is the second step, so we'll go ahead. You will know how to do that later. But we are just identifying what is we identified the contract, we identified the performance obligation. Now we are identifying the transaction price. Then we have to allocate the transaction price to various performance obligations. So it's a step-by-step process. So let's wait some time to answer your question. So company A supplies components to industrial customers. The contract stipulates that the price per component will decrease per unit as sales volume increases within the stipulated period of time as follows. And this is the structure: price per unit 100, 90, 85, and different sales volume. And how is revenue calculated under Ind AS 115? So therefore you apply the probability factor to the sales volume units, and you get a probability weighted sales value and a probability weighted sales volume, and you determine the average price, and the average price comes to 88.93. But your first 100,000 was sold at 100 rupees. Sorry, first 1 million units were sold at 100 rupees. Therefore, when you're recognizing revenue only at 88 rupees, you need to create a liability for the difference of 100 and 88, which is 11 rupees. And that will be a contract liability or deferred revenue, which will get reversed subsequently. Now, in the same example which we have, now you consider the following changes in the fact pattern. A believes that the total sales volume for the year will be 2.5 million based on past experience. So it's instead of this particular structure of 100 into 1 million units and 90 for between 1 million and 3 million units and so on and so forth, what A believes is most likely he would be in a position to sell 2.5 million units at 90 rupees, in which case he would treat, based on the most likely method, the transaction price would be 90 units into 2.5 million units, which is 225 million rupees with an average price of 90. So this is how the most likely outcome will get accounted for. And therefore, for the first 1 million units that are sold, instead of being recognized at 100, they will be recognized at 90, and therefore you will create a deferred sales or a contract liability of 10 per unit sold. So the question of using the expected value or the most likely method depends on the probability. If there are multiple probabilities, multiple outcomes, you use the expected value method. But if you are very confident that this is, in my case, I believe most likely I'm going to sell 2.5 million units at 90 rupees, then you don't have to use all these probabilities. You use the most likely outcome method. And there is no free choice that I will use expected value method and sometimes I'll use the most likely outcome method. There is no free choice. Depending on the fact pattern, you either fall in the expected value method or you fall in the most likely method, and you have to use those methods consistently from year to year unless facts change. Now, returns. All of you may have experienced goods returned, right? Now, typically the way we account for goods returned in AS9 is substantially different from the way we recognize goods returned in Ind AS 115, and we'll see what those differences are. Right of return is a form of variable consideration. Revenue recognition is limited to amounts for which it is highly probable a significant reversal will not occur, that it is highly probable that the goods will not be returned. A refund liability is established for the expected amount of refunds and credits to be issued to customers. So therefore, let's say if I sell you 100 units of a particular good and you believe 25 units will be returned back, you recognize sales only for 75 units, and for the 25 units you have received cash, what are you going to do? Treat it as a deferred sales or a contract liability, right? So you recognize revenue only to the extent you believe that the sale has got consummated. To the extent it is highly probable that goods will be returned back, to that extent you do not recognize the sales, but you create a contract liability. Now let's take a simple example. Game company sells 1000 video games to distributor for CU50 each. Distributor has a right to return the video games for a full refund for any reason within 180 days of purchase. The cost of each game is CU10. Game company estimates based on the expected value method that 6% of sales of the video games will be returned, and it is highly probable that returns will not be higher than 6%. So therefore, when it is highly probable that returns will not be greater than 6%, what is the sales you will recognize? 94%. So in this case, I have sold 1000 units. I have got 50 rupees for that 1000 units. I have got 50,000 rupees. So bank debit 50,000 rupees. I am recognizing sales only for 94%. So revenue would be credited for 94%, which is 940 units into 50. So therefore your revenue is 47,000. I am creating a contract liability for the 60 units that I believe will be returned back to me. So 60 into 50 is 3,000. I have a cost of sales for the goods I have sold. The cost of sales is 10 per unit. So cost of sales 940 units sold into 10 per unit is my cost of sales, which is 9,400 debit. Other assets, which is the 60 goods that will be returned back to me, will be treated as other assets. The 60 units of goods that I hope will come back to me is treated as other assets, not as inventory. And I will take that as 60 units into the cost of that asset, which is 10 rupees. So the other asset value is 6,000, and I have disposed of inventory of 1,000 unit at 10 rupees, which is 10,000 rupees. Now here you have the return assets, which is the other assets, which are lying with the customer and which you hope they will return back, and on that basis you have recognized revenue only for 94%. These return assets may get impaired because the customer may have used it and may be returning to you in a bad condition. So the return asset will be presented and assessed for impairment separately from the refund liability, and this impairment will have to be assessed on an ongoing basis. So essentially the big point is that as far as returns are concerned, you only recognize revenue for what you believe you've actually sold. To To the extent you believe that the units will be returned back, you can't recognize revenue, you have to create a contract liability. Yeah, because they are not your inventory, they are actually lying, it has moved out of your inventory. So the other asset is your right to recover it back from the customer should the customer give it back to you. So that's why it's other asset, it's not inventory. So therefore this liability, this contract liability of 3,000 and these other assets are shown separately in the balance sheet. They can't. No, it is out from your inventory. So you have inventory credit 10,000 rupees as an other asset, as other assets, yeah, other loans and advances and other assets, not as inventory. You can't treat it as inventory. It should be current because you are expecting it to, because it's 180 days, no? It's not more than 360 days, so it will be current. Sorry? No, you have to separate them in the balance sheet. No, it's perfect. The entries are matching, so I don't understand your question. I don't understand it. What is it? So that's your margin, no? So if supposing you do not get any goods back and the customer has used it, yeah, you will reverse the liability of 3,000, you will reverse the other assets of 600 and you will recognize your margin of 2,400. No, disclosures are multiple. We will get to, you are on slide 105. So multiple disclosures are required. But in the balance sheet, you can't net off these items. You have to show gross. Okay, now we get to financing component. Right, you had a question? Yeah. You have a mic, can you move the mic?
In that case, my corresponding cost of sale will be 400 or I have to reverse an impairment loss?
You have to reverse the impairment now, because you are getting more money. So your margins will go up because you have already created an impairment.
That will be.
So your margin will not be 2,400, but it will be 2,400 plus your 200 of impairment that you have provided.
So it's going to be a reversal of impairment loss.
But that 200 reversal of impairment will be below your gross margin line. So it will not be in your sales and cost of sales.
Okay.
Okay, now let's go to the significant financing component. Now, very often what happens is either you provide finance to your customer or the customer provides finance to you, right? When does the customer provide finance to you? When they are paying you an advance and you are delivering the goods after a year. And when do you provide finance to the customer? When the customer is paying you after 6 months or 9 months and so on. So either you are financing the customer or the customer is financing you. Now, when you are financing the customer, what is the rate of interest you will take for the purposes of separating interest and goods and services? What is the rate of interest you will apply when you are financing the customer? It is the customer's borrowing rate. And when the customer is financing you, what is the rate you will use? It's your own incremental borrowing rate. Do you get it? So when I am financing a customer, I have to separate the financing component based on what is the customer's incremental borrowing rate, or what is the rate at which you will lend to the customer, and vice versa. When the customer is financing you, what is your own incremental borrowing rate? So financing component is reflected as an adjustment to the transaction price when significant, and the primary purpose of the payment term is to provide financing to one party in the contract. Now, financing component evaluation is not required if customer is expected to pay within 1 year of when control of the goods or services transferred. So if the financing component is not greater than a year, the financing is not greater than the year, then you have a choice. You can either separate the financing component or you may not want to separate the financing component, provided the financing component is not greater than 1 year. and the financing component is not significant. If the financing component is not significant, again you have a choice of either separating the financing component or not separating the financing component. And the effect of financing to be reflected separately in the from revenue, either as a finance cost or a finance income. So if you have borrowed, it's a finance cost. If you have lent, it's a finance income. No, it will act for every transaction. You have, for every sales that you make, if there is a financing involved, you have to separate the financing element. Yeah, because your interest rate may also change. But again, you have to go on the basis of materiality. So your interest rate may be 5% at the beginning of the year, at the end of the year it may be 8%, 9%. So let's look at an example. This is an example of advance payment where a customer has given you advance payment. An entity enters into a contract with the customer to sell an asset. Control of the asset will transfer to the customer in 2 years. That is, the performance obligation will be satisfied at a point in time. The contract includes two alternative payment options. Payment of 5,000 at the end of second year when the customer obtains control of the asset, and payment of rupees 4,000 when the contract is signed. The entity's incremental borrowing rate is 6%. Now, in this case, can you use the practical expediency of not separating the financing element? What is the financing period? 2 years. And what was the exception for? 1 year. So you can't use the practical expediency because it is greater than a year, so you have to separate the financing element. Can you take the practical expediency of materiality? In this case, the financing element is pretty material, right? So you're looking at 4,000 versus 5,000, and therefore your incremental borrowing, if you do an IRR between 5,000 and 4,000, it may work to about 11% or so. So therefore the financing component is significant because the interest rate is significant. Having said that, if the transaction is small, the value is small, then you really don't have to separate the financing component. But if you have engaged into these kind of transactions, numerous transactions at 11% IRR, then the financing component is significant, which you need to separate. So in case the customer opts to pay advance payment upon signing, it seems that the contract contains a significant financing component because the difference between the amount of the consideration under the two option is significant. 1,000 on 5,000 is literally 20%, so it is significant. The expected length of time between payment of advance and transfer of goods is significant, 2 years. And the interest rate implicit in the payment option, which is 11.8%, is also greater than the incremental borrowing cost of 6%. Therefore, even on that basis, it is a significant. And therefore, you need to separate the financing component. So the journal entries will flow like this. You have received cash from the customer of 4,000 rupees, and therefore you have a contract liability of 4,000 rupees. Over 2 years, you will recognize an interest expense on a regular basis, every quarter or every year, depending on whether you do quarterly accounts or annual accounts. 4,000 at 6% for 2 years, assuming interest on interest, is 494 rupees. So there will be interest expense debit to contract liability credit. And ultimately, when you sell the goods, you will say contract liability debit 4,494 to revenue credit 4,494. Now this is an advance that the customer has paid, but if you had financed the customer, it would be, instead of interest expense, the same thing would have been an interest income. So that is how you need to separate the financing component from the transaction price. Now, non-cash consideration. Sometimes you may not get cash for selling the goods and services. You may get some non-cash consideration. Maybe you may get land, or maybe you may get some inventory. So the way you do the non-cash consideration is, what is the fair value of the non-cash consideration? If that is easily determinable, that should tell you what is the transaction price. If you are not able to determine what is the fair value of the non-cash consideration, what is the fair value of the goods and services you are selling, that would be the value of the transaction price of that contract. So first, step one is to fair value the non-cash consideration itself, to identify or determine the transaction price. If that is not clear, then the fair value of the goods and services that you are selling should determine what the transaction price is. And obviously you will have to apply if it's a variable consideration, then you will have to apply all the constraining factors and so on. Now this is a very important concept and we don't realize this very often. There is a consideration payable to customer. You pay a consideration to a customer. Now typically it happens across various industries, but just to give you an example, for example, I'm selling goods to a retail outlet and I'm saying you sell my goods, but what I will do is I will pay you something more. You display it properly on your shelf so that my goods get sold. So that is the consideration, additional consideration I pay to the customer, saying that I have sold you my goods and services, you are paying me for my goods and services, but I will pay you something so that you display my goods and services properly on your shelf. So that's a consideration that I pay to a customer. And how do I account for that consideration that I pay to a customer? Different rules will apply. Now let's see what the rules are. Essentially, if you are paying to the customer for a distinct good or service, if the customer is giving you some unique service or some different or distinct good, then you will treat it as a purchase of that goods and service. But if it is not a distinct good and service that you are receiving from that customer, then you will reduce it from your transaction price, right? Now let's explain this with the help of an example. Entity enters into a contract with a customer for the exclusive supply of paint for a 3-year period. Entity makes rupees 50,000 upfront payment to the customer, which the customer will use to customize its paint sprayers for the entity's product. Entity determines the upfront payment is not in respect of a distinct good or service. Therefore, 50,000 rupees is accounted for as a reduction in the transaction price. An entity estimates that 1 million in sales with the customer over the 3-year period. So how are you going to, so entity is estimating 1 million sales from the customer over the 3-year period. How are you going to allocate 50,000 that you receive from the customer? As you recognize the sale of 1 million over the 3-year period. So it will reduce your transaction price over the 3-year period. Now how does it happen? Let's run with the same example. So let's example for the first quarter, my sales is 100,000 rupees. What is the total sales I'm expecting? 1 million. What is the sales in the first quarter? 100,000, right? So 100,000 on 1 million is 10%. Right? 10% of the 50,000 upfront payment that I receive from the customer is how much? 5,000 rupees. So therefore, I will recognize sales of 100,000 minus 5,000 rupees. I will recognize sales of 95,000 rupees. So essentially, the consideration that I pay to the customer, I am reducing it from my sales value. Now come to quarter 2. Quarter 2, the sales is 125,000. Now the entity updates the estimate of total sales over the contract to be 1.5 million. What was its earlier estimate? 1 million. Now what is its estimate? 1.5 million, right? So far, how much sales have happened? 100,000 and 125,000. So 225,000 of sales have happened. What is 225,000 on 1.5 million? 15%. So what is the amount that I will reduce from revenue? 15% of 50,000. 15% of 50,000 is how much? 7,500. But I have already reduced 5,000 in the earlier quarter. So this quarter I will reduce how much? 2,500. So you have to constantly keep updating, not only for these kind of things, but for a lot of things that you have already heard from. A constant updating of the estimates is required. Yeah, reverse. Yeah, you have to reverse because you do a cumulative catch-up. Taxes, you have to talk to your tax consultants. See, as I said, taxes are purely going to be based on invoice amount. They are not going to be based on this accounting. So if you have invoiced 100 to the customer, you will be taxed for 100. The consideration that you have paid to the customer is a separate thing. I don't know how you treat the consideration paid to a customer for indirect taxes. But if supposing that is not considered, then it generally goes with invoice and what you have billed to the customer. Okay, now this example is very interesting. Producer sells energy drinks to retailer at a convenience store. Producer also pays retailer a fee to ensure that products receive prominent placement on stores. The fee is negotiated as part of the contract for sale of the energy drinks. So basically what is happening is I am selling something to a retail outlet, and I am paying them what is called a slotting fee. Do you know what is a slotting fee? Slotting fee is a consideration that I pay to the customer or to the retailer to say that you prominently display my goods on the show, on your shelf, and I'm paying you something called the slotting fee. Now, how would you account for the slotting fee? As a cost, advertising cost, or as a reduction from the transaction price? It depends. That's a very good answer. No, not on that. Why is it a reduction from the revenue? You are giving them a discount, but I'm not getting the answer that I want. Yes, you are giving them a discount in some other form, but I want the answer that I'm expecting. What did I tell you all? I'm paying to the customer, but am I getting a distinct goods or service from the customer? No, I'm not getting a distinct good or service from the customer, right? The customer is ultimately going to sell those energy drinks, and he's prominently displaying in that shelf, but he's not giving you a unique service. This service that I receive from that customer is not unique, it's not distinct from selling the main goods and services. So therefore, if you have paid slotting fees, you will reduce the slotting fees from the transaction price. Now let's take another example. Sorry? It's not a distinct good or service, separate from selling the main good. So that will be a reduction from the revenue. Otherwise, everybody will gross up their revenue and gross up their cost, you know. Okay, now let's take another example of mobile company sells 1,000 phones to retailer for rupees 10 lakhs. The contract includes an advertising arrangement that requires mobile company to pay 100,000 towards a specific advertising promotion that the retailer will provide. Retailer will provide the advertising on strategically located billboards and in local advertisements. Mobile company would have elected to engage a third party to provide similar advertising services at a cost of 100,000. Now in this case, would you reduce it from the transaction price? No. Why would you not reduce it from the transaction price? Because you are getting an advertising service which you would have got from a third party, and therefore the customer is now your supplier for something else, and therefore this should not be reduced from the transaction price. Non-refundable upfront fees. Entities may receive payments from customers before goods or services are provided. In many cases, upfront payments are non-refundable. Entities must evaluate whether non-refundable upfront fees relate to a transfer of a good or services. Fees charged for setup activities do not depict the transfer of services to a customer and should be ignored when measuring the progress of an entity's performance. So let's take an example. Fitco operates health clubs. Fitco enters into a contract with customers for 1 year access to any of its health clubs. The entity charges an annual membership fee of 6,000 as well as 1,500 non-refundable joining fee. The joining fee is to compensate in part for the initial activities of registering the customer. Customer can renew the contract each year and are charged the annual membership fee of 6,000 without paying the joining fee again. If customers allow their membership to lapse, they are required to pay a new joining fee. How are you going to recognize this 1,500? How are you going to recognize 1,500? Over the right. So if you estimate that this guy is going to remain a recognized, so I would be providing him services for 3 years. So this upfront payment of 1,500 is in lieu of the services that I'm going to provide him for 3 years. So I will allocate 500, 500, 500 in each of those 3 years. Sorry? No, you have to make an estimate. You have to go with your historical data and make an estimate. Now let's we get to the next step. Fortunately, we still have. Okay, we have to now rush a little bit. I think I've got carried away with all these examples. We have already 250, so we have to break at 3:30. So we have about 40 minutes. I think we are good. So now, we have identified the contract. We have identified the performance obligations in the contract. We have determined the total transaction price. Now what is the fourth step? What is the fourth step? Now you have to allocate the transaction price to the various performance obligations. So basically you allocate the transaction price to the various performance obligation based on the relative standalone selling prices. Now the standalone selling prices should be the one that are clearly observable. Okay, I know that this software, this is the price, this installation, this is the price. So it has to be based on observable prices that are available. But in many cases you may not have an observable price for that performance obligation. You have an observable price for the whole contract but not for the performance obligation. Then you have to determine that observable price, which is based on an adjusted market assessment approach or a cost plus margin approach. You can also use the residual approach. Now let's see how this actually works. Now once you determine the standalone selling prices at the inception of the contract, those are not updated subsequently. The allocation happens based on the standalone selling prices that are there at the inception of the contract. Now entity enters into an agreement to sell hardware, professional services and maintenance services for 200,000. So how many performance obligations are there? 3, right? Hardware, professional services and maintenance services. Entity determines that each of the promised goods or services represents a separate performance obligation. Because the entity frequently sells professional services and maintenance services on a standalone basis, it uses those transactions to determine the standalone selling price, which is 25,000 and 15,000 respectively. The entity rarely sells the hardware on a standalone selling basis, so it estimates the standalone selling price at 185,000 based on the hardware's underlying cost, the entity's targeted cost and the amount of margin the entity believes the market will bear. Now therefore, you have transactions, standalone selling prices for professional services and maintenance, which is 25,000 and 15,000. You don't have standalone selling price for hardware, but you estimate the standalone selling price for the hardware on a cost plus margin basis, which is 185,000. So what is the discount that is there in this contract? So 25 plus 15, 40, 40 and so 225, right? So you have 25,000, 15,000 and 185,000, which is 225,000. But the total contract value is only 200,000. So you have to allocate a discount of 25,000. And how will you allocate the discount of 25,000 to each of those 3? Simply based on their relative standalone selling price. So on the basis of relative standalone selling price, you have a discount allocation and you have the allocation of the transaction price, which is essentially 200,000, right? So this is how you allocate the discount on the basis of the relative standalone selling price. No. But you don't know what they are. You don't know what they are, so you have to make an estimate. And when you make a margin for each of those three, ultimately the margin that you get on the overall contract is lower. Therefore, you have to do the allocation, right? So if my margin is 10%, 10% and 10% on each of the performance obligation, right? But on the total contract, my margin is 5%. Where will I pass on the burden? So you use the relative standalone selling price. Okay, now assume the same fact patterns in example 1, except that the arrangement also includes software for a total fee of 250,000. The entity determines the software deliverable is also a separate performance obligation. The entity never sells the software on a standalone basis. The entity has bundled the software into a number of different arrangements with the pricing for that element ranging from 15,000 to 125,000. So the pricing of the software is very volatile. It could be as low as 15,000 and as high as 125,000. In that case, you use the residual method, which is the total consideration in the contract is 250,000. The hardware is 185,000, professional services 25,000, maintenance services is 15,000, and therefore on the residual method, the standalone selling price of the software is determined to be 25,000. So in this case, where the prices are very volatile, a huge gap, you use the residual method to determine the price of the software. It's just an example to make the point. There can't be such a huge difference. You're right. So now let's say this is the allocation, right? Hardware 185,000, software 25,000, professional services 25,000, maintenance services 15,000, which is 250,000. Now, the professional services are more valuable to the customer if they are rendered as soon as possible, and therefore the customer is providing you with a premium of 10,000 rupees on the professional services. So assume the same fact patterns as in example 2, except that the contract price will include a 10,000 premium or variable consideration if the professional services are provided within 7 days of the delivery date of the hardware and software. So in this scheme of things where you have allocated based on the relative standalone selling prices, where are you going to allocate this 10,000 rupees? To purely to professional services. You will not allocate that to all the 4 performance obligations. You will allocate that to purely professional services because they are meant for professional services. Take another example where we do not allocate the discount to all the performance obligations. And when will that be the case? An entity enters into a contract with the customer to sell television, speakers and entertainment unit for a total of 2,100. The television and speakers are delivered at the same time. On a regular basis, the entity separately sells the television for 1,700 and speakers for 3,000 and the entertainment unit for 300. In addition, the entity regularly sells the television and the speakers as a bundle for 1,800. Now in this case, the customer purchases all the 3 for 2,100, receiving a discount of 200. Now this 200 discount will be allocated to all the 3 performance obligations. Will it be allocated to the television, speakers and the entertainment unit? Sorry? Because there is hard evidence that this 200 discount pertains to television and speakers, so it will be allocated only to television and speakers. It will not be allocated to the entertainment unit, and consequently what will be the consideration for the entertainment unit? 300. Good. Now what I am going to say is very important, not only from the perspective of real estate companies, construction contracts, but a lot of product sales as well. So we are now on step 5. What we did, first step, identify the contract, identify performance obligation, identify the total transaction price, allocate the total transaction price to the performance obligation. But we have still not recognized any revenue. After 4 tough steps, we have still not recognized any revenue. So the 5th step is recognize revenue. And when are you going to recognize revenue? When the performance obligations are satisfied. When each of the performance obligations are satisfied, you are going to recognize revenue. But it is not so easy. Why is it not so easy? Revenue is recognized when an entity satisfies a performance obligation by transferring a promised good or service to a customer. A good or service is considered to be transferred when the customer obtains control. Performance obligations are either satisfied over a period of time or at a particular point in time. And when is it satisfied over a particular period of time versus at a point in time? Now, in these three situations, control of goods and services is transferred over a period of time, not at a particular point in time, over a period of time. And it is very important to understand, when something is satisfied over a period of time, you can recognize revenue over a period of time. When something is satisfied at a point in time, you recognize revenue only at a point in time. Now, these three situations where control of goods and services is transferred over a period of time. The first one is the entity creates or enhances an asset that the customer controls. The entity creates or enhances an asset that the customer controls as it is created or enhanced. Any examples? When does the entity create or enhance an asset that the customer controls as it is created or enhanced? Sorry, somebody there? Yeah, so to give you a simple example where he was, so let's say I am constructing an equipment for the customer at his site and the customer controls that equipment as I am constructing that equipment. So the entity as a supplier, I am creating or enhancing an asset that the customer controls as it is created or enhanced. Therefore, the customer is controlling the work in progress. So in that situation, it would be as if I am transferring or as if I am performing on the performance obligation and satisfying the performance obligation over a period of time. So I am continuously transferring goods and services or continuously transferring the equipment to the customer, and therefore the goods and services are transferred over time. Now the second one, the entity's performance does not create an asset with alternative use, and the entity has a right to payment for performance completed to date. Now this would typically apply in the case of real estate. So let's say you have a building and there are 100 flats in that building, and there are 100 customers who have bought the building as the building is getting constructed. Now, typically in these real estate contracts, you have gone and purchased a particular flat while the flat is being built. Do you have control over that work in progress? Do you have control over that work in progress? You don't have control in the work in progress. You can't go and take that half constructed building and say, look, I will get my own contractor to do the remaining work. So you don't have control over that work in progress. But does it create an asset for the contractor with an alternative use? For the builder, does it create an asset with an alternative use? No, the builder cannot sell it to a third party. So that half constructed property is not creating an asset for the builder which will have an alternate use, because the builder can't give it to a third party. And the entity has a right to perform, and the entity has a right to payment for performance completed to date. So typically what it means is, in a real estate contract, if the builder is constructing something, he does not have an alternate use for what he is constructing because somebody has already purchased it and there is a contract. And he has a right to receive payment for performance completed to date. So therefore, if he has completed 50%, he has a right to collect 50% from the customer. If the customer says, I want to walk out, the builder says, you can walk out, but you have to pay me 50% because I have completed 50%. If that right exists with the builder, it would be deemed that control in that property is being transferred to the customer over time. If the builder does not have the right to collect payment for performance completed to date, then it would be said that the builder, the particular criteria of transferring control of goods and services to the customer is not fulfilled. And the third criterion, the customer is receiving and consuming the benefit of the entity's performance as the entity performs. So typically in the case of cleaning services and clearing services, the customer is enjoying the benefit. So let's say you're shipping the goods from point A to point B. and the ship is halfway between, right? The customer has got a service. Has he got a service or not? Or will you say that the customer has got a service when the ship has reached point B? No. So the principle is the customer is receiving and consuming the benefit. So the customer has already got the benefit of the goods having been transferred halfway through, and therefore even in that case it would be said that the performance obligation is being satisfied over time. Because this is very important. The moment you say that the performance obligation is not satisfied over time, you would recognize revenue when the goods reach point B. But when you say that the performance obligation is being satisfied over time, you would recognize the revenue as the ship is sailing. So therefore, this is a very important consideration to keep. So there are three criterions to determine when the transfer of goods and services are happening over time. The three criterion, I repeat: the entity creates or enhances an asset that the customer controls as it is created or enhanced. The entity's performance does not create an asset with alternate use for the entity, and the entity has the right to payment for performance completed to date. And the customer is receiving and consuming the benefit of the entity's performance as the entity performs. Now let's focus on the real estate example, because this is important. In real estate, would you believe that the contractor can apply percentage of completion method? In which of these boxes the real estate would fall? In which of these boxes the real estate would fall? Yeah? In which of these boxes the real estate accounting would fall? In? Oh, sorry. Okay. So, this is unfortunate. But this is very important, so I don't know why we've. So basically what we are saying is the middle box, where the entity's performance does not create an asset with alternative use, and the entity has the right to payment for performance completed to date. So when the real estate contractor, I don't know how we can do it, if we can change the color. Okay, I'll read it out for you. The first box says the entity creates or enhances an asset that the customer controls as it is created or enhanced. That is simple when you are constructing somebody for a customer and the control is transferring on an ongoing basis. And the second one is the entity's performance does not create an asset with alternative use, and the entity has a right to payment for performance completed to date. So typically in a real estate contract, you can recognize revenue, and you can recognize revenue on the basis of percentage of completion method if the contractor doesn't have an alternate use for what he has sold, which is fulfilled. The second condition is, does the contractor has a right to receive payment for performance completed to date? If the contractor has a right to receive payment for performance completed to date, that condition is fulfilled, and the real estate accounting can happen on a percentage of completion method. But this is the point here, that very often the builder's right to receive payment for performance completed to date does not exist. And can you give me some examples where it does not exist? Where it does not exist?
Sir, now they are floating a scheme where pay only 20% and get the payment 80% after 3 years.
Fantastic. So basically, if you have a scheme of 20-80, where the builder says you pay 20% now and 80% on completion. Now, if the customer walks out halfway through, the customer is saying, look, I'm going, and the builder has no right to receive payment for performance completed to date. Builder has completed 50%, 60%, but he has no right to receive payment for performance completed to date. He can't recognize revenue on the percentage of completion method. That falls back on completed contract method. Another example is this Maharashtra Rent Control Act. In Maharashtra Rent Control Act, for example, and each of the states will have different laws. In Maharashtra Rent Control Act, a customer can clearly walk out, and all that the customer has to do is pay a 10% penalty. and get all his money and pay a 10% penalty. In these cases, the builder does not have a right to receive payment for performance completed to date, and therefore the builder cannot use percentage completion because he is not transferring control of the goods and services on a continuous basis. So this is an important point that you really need to remember. So typically in the 2080 case or under Maharashtra Rent Control Act, where the customer can walk out and the builder has no right to receive payment for performance completed to date, accounting will be on a completed contract method and not on a percentage completion method, because the assumption is that the control of goods and services is not happening continuously. And when you're doing accounting, when you're doing construction accounting, or this, when you're saying that the performance obligation is being satisfied over a period of time, then the construction cost and the percentage completion is very similar to what we are doing currently under AS7 and AS9. So those things will remain the same. Now, if the performance obligation is not being satisfied over a period of time, then it is being satisfied at a point in time. And when is it being satisfied at a point in time? Indicators that control has passed over at a point in time includes a customer having a present obligation to pay, a customer having physical possession, a customer having legal title, risk and rewards of ownership have transferred to the customer, and the customer has accepted the asset. So the point in time when the control transfers to the customer is not dependent on any one factor. It's dependent on numerous factors: present obligation to pay, physical possession by the customer, legal title has passed to the customer, risk and rewards of ownership have passed to the customer has accepted the goods and services. So it's not one factor. You have to look at all the 5 factors and take a decision in totality whether the goods and services have been transferred or not at a particular point in time. Now let me ask you a simple question here. You have to be very careful whether something is revenue or something is not revenue. Let's take a simple example. Manufacturer of scissor lifts. You know what are scissor lifts? They are like scissors going up. Generally it's launched on a vehicle, scissor lift. So manufacturer of scissor lift equipment enters into an agreement to sell 6 scissor lifts. The agreement includes an unconditional obligation of the manufacturer to repurchase the scissor lift equipment from the customer in 3 years for 70% of the original purchase price. What is this contract? Is it a revenue contract? It is an operating lease, because what it's saying is I am transferring you these goods and services for 3 years and you pay me 30%. So therefore this is an operating lease. This should not be taken as a revenue transaction. So it's very important to understand what is a operating lease versus what is a revenue transaction. In this case, when you're going to get the goods back and you have to pay him 70% back, then this is an operating lease, because effectively you are charging him 30% for using your asset for the next 3 years. Now let me ask you a different question. Let's say you have sold an asset to a particular customer, and the customer is going to return the asset back to you. Now you have sold the asset to the customer at 100, and when the customer returns the goods back to you, he pays you 110. Now what is this transaction? Is it a revenue transaction? Is it a sale transaction? It is typically a financing transaction, because the goods and services are more of a security, and the 10% more that you are getting is a finance income or a finance expense. Now, those of you who are not familiar with bill and hold arrangements, so let's say I have goods and services, I produce those goods and services for the customer, and I am telling the customer, I am holding these goods and services, or I am holding these goods in my factory, and these are your goods and services, but I am holding it in my factory. Would you be allowed to recognize revenue under Ind AS 115? You have not delivered the goods to the customer. You are holding those goods in your own factory at the behest of the customer. Would you be allowed to recognize revenue? Yes or no? partly right. So depends on whether control of goods and services have been transferred to that particular customer. Part of it. Now warranty accounting is again very different. You have to assess the nature of the warranty. Does the customer have an option to purchase warranty separately? If the customer has an option to purchase warranty separately, it would be treated as a separate performance obligation. If the customer does not have the option to purchase the warranty separately, then it is a separate performance obligation. Will it be a separate performance obligation in that case? So if let's say the customer has an option to purchase the warranty separately, you may or may not purchase, but he has an option to purchase the warranty separately, then in that case it would be treated as a separate performance obligation. If he does not have the right to purchase that warranty separately, then you have to make an assessment of whether the warranty includes an assurance type warranty or a service type warranty. And I think the best way to deal with it is through an example. And this is a very important example. Entity sells 100 ultra-light batteries for 20 each and provides the customer with a 5-year guarantee that the batteries will withstand the elements and continue to perform to specification. The entity which normally provides a 1-year guarantee to customer purchasing ultra-light batteries determines that years 2 through 5 represent a separate performance obligation. The entity determines that rupees 1,700 of the 2,000 transaction price should be allocated to the batteries and 3,000 to the service warranty. The entity normal 1-year warranty cost is 1 rupee per battery. Now in this case, what is the assurance warranty and what is the service warranty? What is the assurance warranty? The assurance warranty is 1-year warranty. And what is the service warranty? Additional warranty 2 to 5 years. Now what is the cost of the assurance warranty? What is the cost of the assurance warranty? 1 rupee per battery, right? And what is the pricing on the service warranty? What is the pricing on the service warranty? 300 rupees, right, for that service warranty. So the way you would account for this is, first you have received cash of 2,000 rupees and you have recognized a revenue of 1,700 rupees and you have recognized a service warranty liability of 300 rupees. Now this service warranty liability of 300 rupees, how are you going to account for it? Over the service period 2 to 5. Okay. So the service warranty that you are going to give, you have created a liability for that. That you will recognize as a revenue over the service period. As the assurance warranty, what you will do, you will create an expense. You will not reduce it from the revenue. So for the assurance warranty, you will say warranty expense debit, which is 1 rupee per battery, which is 1 into 100, which is 100, and you will accrue a warranty cost. And this warranty expense, which is the assurance warranty, is typically the way we do accounting under Indian GAAP for warranties. But the service warranty will be treated as a separate performance obligation. It will be reduced from the transaction price and it will be recognized as revenue over the service period. Is that clear? So service warranty is going to be treated as a separate performance obligation and recognized over the period of the service warranty. Assurance warranty will be treated as a cost like you do it under Indian GAAP, right? Now, contract cost. What are the costs that you can capitalize as inventory cost or as contract cost? So typically it says that all incremental cost is to be captured as a contract asset. So let me give you a simple example here. If I am paying commission to a particular party and that commission is to be paid only if the contract is won, is that an incremental cost? So let's say I am bidding for contracts and I have got an agent and I tell the agent that only if I win this contract I will pay you a commission. Is that an incremental cost? It is an incremental cost because it is paid to the agent only if you win the contract, and therefore the commission cost in this case will be treated as a contract asset or a contract cost and it will be capitalized as a contract cost to be amortized for future years. Now let's take another example, bidding cost. I have spent a lot of money in making a bid for the contract. Is that an incremental cost? The bidding cost is not an incremental cost because I would have to incur even if the contract is lost. And therefore you cannot capitalize that as a contract cost. You have to charge it immediately to the profit and loss account. So those are the things that you need to really know. Sorry? Yeah, this is actually an IFRS presentation where they use CU rather than rupees. Maybe I need to do yeah, it's a currency unit. Maybe I need to do a spell check and change CU to rupees when I'm doing the presentation in India. When I do presentation abroad, I'll have to restate it back to CU. So transitional provisions, when you apply the standard for the first time, virtually no transitional exemptions are there. The transitional exemptions are very minor, so therefore effectively for all your contracts that are outstanding, as of if you are in phase 1 and therefore you have to start applying the standard from the 1st of April 2015 because that's your transition date, virtually no transition relief. So you have to really go contract by contract, determine what is the variable consideration, what is the discount. All of those things will have to be done as of 1st of April 2015, and all those things will have to be accounted in your opening balance sheet. So there is no relief. The reliefs that are there are very minor, and I don't think we have a lot of time to discuss that, but effectively you will have to go contract on contract to find out what is the financing component, what is the variable consideration, and you will have to account for it. You can't grandfather it. You have to account for it as if those contracts, as if you had applied the accounting when the contract was first obtained. So there are numerous presentation and disclosure requirements. I don't have to get into all of that. I mean, I have written a book with another colleague of mine on Indian accounting standards, which is Ind AS, which has been recently published a month back. A lot of what I have spoken would already be there in the book. So those of you who were sleepy, who have not understood what I said, maybe you can go and buy my book, and in your spare time, maybe it could cure your insomnia in the night if you keep it below your pillow or something like that. So those of you who want to buy this. I think there are a lot of other things that I would have said, but I don't think we have the flexibility and the benefit of time. But if you have any questions now on revenue recognition, I'm happy to answer that. So if I were to just summarize the 5 steps, identify the contract, so if I were to just summarize, identify the contract, identify the performance obligation, find out the total consideration, allocate the total consideration to the performance obligation, recognize revenue as you fulfill those performance obligations. These performance obligations are either fulfilled at a point in time, therefore you will recognize revenue at a point in time, or there are some performance obligation that is satisfied over time, you will recognize revenue over time.
Sir,
and then you have warranties and those kind of things that you need to be careful of.
Sir, what about loyalty schemes? Generally what happens is the customer, say I am a manufacturer, I sell it to my distributor, the distributor sells it to the retail outlets. I run a scheme at a retail outlet level, based on a retail outlet, that whatever is the retail outlet sale in a particular period, based on that I will give him a reward. Now that reward can either be the company's product or some outside product. For that I have engaged a agent who will, a separate vendor who will manage the loyalty program, the redemption of the points and everything.
Right, so in these kind of transactions, you have to determine whether in executing those loyalty programs, you are the principal or you are the agent. If you are the principal in executing those loyalty programs, you recognize revenue gross. But if you are, so let's say in the frequent flyer miles, right? The airline is providing you with a ticket and then also executing the frequent flyer points on its own airline. So therefore, it will treat the whole of that revenue as its own revenue. But it will recognize the revenue in parts. First, it will recognize the revenue on the first flight that you took, and the other would be as you extinguish those frequent flyer miles. But that party is acting in the context of a principal. But if, let's say, if I were to sell you something, and I say, look, I'm going to give you a voucher of 10 rupees, which you can buy goods from somebody else, and I'm not going to be responsible. In which case, you will recognize 90 rupees as the sale rather than 100 rupees as sales.
So
Whereas in the frequent flyer example that I gave, you will recognize 100 rupees, but you will recognize first 90 rupees, and when the frequent flyer miles is extinguished, you will recognize the other 10. So it depends in those kind of contracts whether you act as the principal or you act as an agent.
So the challenge is I sell a bouquet of products and they get reported in different segments. But loyalty points, it may not be possible for me to segregate for which product I am giving that loyalty point. And some of the loyalty points may be a total at a company level. Say first time enrollment, I give it 1,000 reward points, or maybe achieving a total combined turnover, I give another additional points. So how do I distinguish when I reduce it from my revenue?
I have not really understood your point, but I think you have to make an estimate. We'll take this offline because I've not really understood what you're trying to say. But typically, any such additional options that you give for goods and services, that is treated as a separate performance obligation to be accounted for separately. But if you're not giving additional goods and services, so typically, let me give you an example. Let's say a lube company such as Castrol, it's selling lubes to the distributors and it's putting a cash coupon inside the box. Now, when the distributors are selling it to the final mechanics and the garages, the mechanics are getting the cash coupon, they're coming to the distributor is paying them, and the distributor is recovering from that lube company. In this case, because it's a cash coupon, you're actually paying cash. That cash coupon is reducing the value of the transaction. So if you have sold the box for 100 rupees, but you have to pay back 10 rupees, then you will recognize revenue at 90. And in doing so, you will not only treat the distributor as your customer, but even the distributor's customer, your customer's customer also becomes your customer. So typically in this particular example that I gave, under Indian GAAP, people are recognizing revenue at 100 and they're showing 10 rupees cash coupon as a cost expenditure. But under Ind AS 115, because your customer's customer is also your customer, you will reduce that 10 from that transaction price and you will recognize revenue only at 90. I hope I've answered your question. Financing will be on an ongoing basis. So you recognize your revenue on the financing on an ongoing basis, because financing expense and income happens on a time value basis as the time expires. As far as the main obligation is concerned, that depends on when you transfer control of goods and services to the customer. Financing will be on a periodic basis. Yes, so you will consider the breakages. So if you are given, let's say, 1,000 cash coupons of 10 rupees each, it works out to 10,000 rupees. But you believe that only 8,000 rupees will come for redemption, 2,000 rupees will go down the drain somewhere. So you will recognize only 8,000 rupees. So you will consider probability of redemption.
So it's a very simple question. This is related to the cloud service provider. Suppose a company enters into a contract to provide, keep data for 5 years, getting the payment on advance. So how will I recognize the revenue in that case? Say, suppose I'm getting into a contract to keep the data of a company.
Keep the
data, like cloud services.
Okay, cloud services.
Yeah. So in that case, I'm providing the hosting services as well as the applications required to keep the data, and at the same time the support services. So and getting the payment in advance for 5 years. How will I recognize the revenue? Is that every year or?
Yeah. So basically, when you receive the amount, you're going to provide the service for the next 5 years.
Yes.
So firstly, you'll have to identify the performance obligation. In this case, is the performance obligation the provision of the facility to store your documents and so on, and are they distinct? So you will have to go through all those assessments to identify, is it a distinct performance obligation, and what are the distinct performance obligations. For all one knows, you may say that cloud services is I'm providing one service of storing his data or whatever. in which case you would recognize the revenue as you satisfy the performance obligation over a period of time, which is you would consider that advance that you've got over a period of time. Now, but then there is a problem here because there will be a time value of money. You've got all of your money in advance. And particularly when you have this kind of a scenario, separating the time value of money can be very, very complicated. If you look at construction contracts, there is retention money, there is advance, and you are doing some activities, some work is getting completed, some money is flowing in, some money is going out. Separating the whole separation of time value of money in those kind of situations can be very, very complicated. It depends, sometimes it depends I'm very wary of giving quick answers because a lot will depend on the detailed fact pattern. And sometimes people are very smart. The way they would construct, I'm not talking about you, but generally being the technical head of the firm, the people who come to me with a question, they construct the question so smartly that it's destined to get to a particular answer. And I can give you a very nice anecdote of two people going to the church, and one of them they want to smoke. So one of them goes to the priest and she says, "Father, while I'm praying, can I also smoke?" So the father is saying, no, you can't smoke. This is against our religion. When you're praying, you can't smoke. Fine. So the other guy goes to the same priest and says, "Father, I'm smoking, but while I'm smoking, can I pray?" Father saying, "Yes, you can pray all the time. You should pray all the time." So the way you construct the question, sometimes the answers, get determined on that basis. So I'm very wary of giving very quick answers because some of your fact patterns are very detailed. It needs to be understood. This is a highly complicated standard. There is no quick answers to it. But you would have access to me. You could always get in touch with me whenever you want to. Sorry? No. So right now the world is applying IS 18 and they will apply IFRS 15 in 2018. Whereas we are the guinea pigs or the scapegoats having to apply the standard right now when there are so many interpretation issues. Okay, if you can dismiss me. Thank you. Thank you very much.